how are you positioned ahead of potential fiscal stimulus? Does it affect your decisions and the moves you're making right now?
Yeah, it has over the course of the last several months, actually. Our base case scenario is whether it happens in the next 2 weeks or the next 6 weeks, we're going to get another stimulus plan, which we think is going to be somewhere in the neighborhood of $2 trillion, which adds to the stimulus this year, believe it or not, of $5 trillion of stimulus. Remember, in 2008, we did about 2.5, 2.8, so twice what happened in 2008. Therefore, we continue to remain pretty constructive on equity assets, but we want to be very, very careful here. You want to make sure you're buying assets that have staying power. As was mentioned earlier by Stephanie, some of the names that are out there right now are more trading names rather than investable names. We like investable strategies. We think that is what gets you through this really tumultuous time we're going to have in the next 60 days. And if you've got cash, you want to sit here and wait, because we're going to have plenty of opportunity to take advantage of volatility.
So you're constructive, including on the cyclicals, though not the trading names, but you want to wait for a more attractive entry point?
Yeah, we're kind of greedy. We're looking for more attractive entry points. I think financials have really long been a sort of taken out to the woodshed as problems that we're going to have related to low interest margin. But I don't think that's the case. I think that you're going to be able to see companies like we just saw in recent earnings reports in the last 2 days. They're going to come back, and I think that earnings stream is going to look pretty strong, and the dividend ratios are just through the roof. So I think that's a benefit for investors.
A case for financials there. Stephanie, wanted to bring up big tech, because all the FANGs underperformed today, and whether that was just the flavor of the markets or the fact that there was a ton of bashing names like Twitter and Facebook, which we'll get to in just a moment. But do you want to lighten the load on technology? I know you have been doing so, but now that the Republicans are coming out after the Democrats last week, they're getting hammered.
I agree. I think today it was a little bit of firstly, to be honest with you, because it's like you question, how do we value these companies? We can talk, and we do talk all the time about total addressable markets and how attractive these growth rates are at these companies, but a lot is already priced in. And so I think they just take a breather, to be honest with you. I still think you want to have exposure to them, like I just said, because they've got such growth in some of these specific end markets, Internet of Things and wearables and AI. That's not going away anytime soon. You're in the second and third inning of AI in itself, and that's $1 trillion total addressable market by the end of the decade. So you don't have to pile in. These are over-owned. This is one of the reasons why, though, when I say, and Will asked me before about the barbell, you do want to have some of this exposure, right? But you do also want to own some of the stuff that really hasn't done that well. And that really is the cyclical, because nobody believes the growth is sustainable. I actually think the growth is sustainable and that the operating leverage is very substantial. So you just got to be patient, pick your spots.
Well, speaking of, we'll stick with that, because Goldman Sachs today put out a call, the team led by Peter Oppenheimer, that tech market dominance may soon come to an end, at least in the short run. The firm downgrading the overall tech sector to neutral and upgrading two value sectors, banks and autos. Goldman saying it expects policy and economic shifts to support a temporary rotation into value stocks in the next few months, and a blue wave this election cycle would support that shift. Excuse me, Stephanie, that must be music to your ears.
Yeah. Well, look, for value or cyclical torque, you do need better growth, and you have to also get a little bit of inflation. So we know we have a ton of liquidity in the system. Michael just mentioned that. We have this new fiscal that's probably coming. If it's after the election or if it's before, it doesn't matter, but it's something like $2 trillion or so. And then if you get the vaccine, all of this should lead to better growth. Does it lead to better inflation? I'm not so sure. But if you look at the growth and then you look at the flows, and the flows have been so weak. You haven't had a surge in flows into value or cyclicals since 2016. And then you look at the tech valuations, as I just mentioned, they're really very high. And so you've got to be very patient there. But the bank, look, if you get a higher growth and a little inflation, rates are going to go up a little bit, and the banks certainly do have leverage there. So, I'm there. I'm there. I'm overweight in the financial services group, that's for sure.
Shepard Smith here. Thanks for watching CNBC on YouTube.